The COVID-19 crisis is just weeks old and the global cost to investors and business is already in the trillions of dollars. The question is, how bad will it get? I spoke to Martin Lakos from Macquarie Wealth Management and Damien Klasson from Macquarie Business. Martin Lakos, welcome. Damien Klasson, great to have you in Melbourne. Let me start with you, Damien. Is this a black swan moment?
Look, I object to the term black swan. I think for me a black swan is something that's not only unlikely but you never even thought could possibly happen. Whereas this has been an event for weeks now. We've known about it. 3 weeks ago, cases were doubling outside of China. Cases were doubling that had actually been transmitted outside of China. 2 weeks ago, they're doubling every 5 days. 2 weeks ago, they're doubling every 5 days. Now they're still doubling every 5 days. I think it's an event which has been pretty well telegraphed. I think the bond markets picked up on it very early. I think the forex markets had started to make some adjustments. I think the equity market's really just been the last one in the group to really wake up to it.
Martin, if this continues to rage on, should people be preparing for GFC 2.0?
This is certainly not a GFC event. It's not a structural event. This is sort of biology versus economics. But we can't trivialise the event as per se, and as Damien's touched on, certainly outside of China now, which China looks like the China situation seems to be getting better and better contained, but outside of China not. We don't really know where this is going. And it is clearly having an impact on consumption and business activity, particularly around the supply chain side. But typically where we have seen these sorts of pandemics before, and this is a big one quite clearly, they tend to be more temporary. Now, we don't know what that actually means in this case in terms of a time frame, and the longer it goes on, the more likely it's going to have a greater impact on consumption and business activity.
I'm going to disagree with that, Martin. With due respect, I think it's way too early to rule out potential for a much larger downturn, and it's not as much the health risks that I'm concerned about. I think there's obviously health risks. I am concerned about the health risks and the potential for a global pandemic. I guess my issue is we've been sitting on this very long expansion for a long time, and we're seeing corporate debt in particular is at cyclical highs. So we've seen corporate debt, since the financial crisis has built up again, and it's sitting at very high levels. We've been sitting, and I think a lot of people have been sitting saying, well, at some stage this cycle will end. We're seeing some very big supply disruptions and very big demand disruptions out of China, and potentially we're going to see that around a whole bunch of areas now, Italy, Iran, South Korea. And my issue is, I don't think you can rule out the chance that we will have some sort of debt crisis based on companies going broke. There's a lot of companies working on very high debt levels and with very little slack in their inventory and their process of actually getting. Everyone's running on these just-in-time inventories. So I guess I'm not sort of saying, yes, I think that's the base case and we all have to prepare for financial crisis, but I wouldn't be so quick to rule it out. I think there's that still needs to be on the table as a potential for where we could see this.
I think there's one key factor here that you haven't touched on, and that's particularly around trying to compare this to a GFC structural issue, and that's the fact that right through 2019, central banks have been very pro-growth. They've been keeping rates down or cutting rates. They've been adding liquidity, and so before the virus actually started to emerge, financial conditions around the world probably been the best for nearly 10 years since the GFC. Yeah. So we've got this buffer that is built into the global economy, along with the fact that quite clearly central banks will have the opportunity to continue to support growth. And also on top of that, governments are clearly going to be taking a whole range of steps. Now, fiscal policy will take some time to move into the economies, but we have no doubt that the Chinese authorities, for example, will be pump priming their economy. Really, we'll see a soft first quarter, no question of that, in terms of a growth number, but we will see authorities really supporting economies and supporting growth. And if we're right around consumption and business activity, if we see any sign of this slowing of the virus, consumption and business activity bounces back almost in a V-shaped recovery. That's not getting overtly positive. That's just the history we've seen in the past.
Let me jump in there. Sorry. Yeah. There's no doubt we've seen stocks take a beating, Martin. $130 billion wiped off just this week alone. Sure. How much further can we see, or can we afford more losses?
Well, again, we have to look at where we've come from. So last year we saw the Aussie share market up around 22%. So we've given back 6. Now that's serious enough in itself. But certainly, you know, if this issue around the virus continues, then clearly volatility and share market falls can continue. There's no question of that. There's some nervousness out there. Equally so, we're seeing a shift of monies into bond markets. So bond markets are rallying. They're a defensive asset, and that's to some extent also supporting what central banks are doing because rates are remaining low. So cost of capital, cost of funding will remain pretty low.
Damien, no doubt travel, tourism, Chinese exposed industries are at the forefront of this. Where do you think the biggest impacts lie?
Yeah, absolutely in those ones. So I guess I'll talk what we've done within our portfolios, and we sort of went through this, at the start of the month in terms of what we tried to do to sort of get our client capital ready for this type of event. Was anything oil related, anything travel related, as you said, a lot of consumer discretionary. I guess our view is that some people are certainly expecting a V-shaped recovery. We don't think people who have been in strict quarantine for weeks or months potentially are going to come rushing out wanting to buy a car as soon as they get out or wanting to go out and spend money on discretionary goods. So we've sort of been a lot of consumer staples and things like that we've put in our portfolios. I guess for us is the issue is that saying, look, central banks will absolutely do what they can to try and get past this, but I think it seems to me a little disingenuous to say that there's going to be a big downturn, we're going to lose all this supply and all this demand, but central banks have got our back and they're going to bail us all out. When we know that, as we said, central banks have actually been pumping money in already because they're worried about the economy. They've shot most of their bullets. Now we've got to get into some very unconventional. And as you said, what we're really waiting for is governments to step up and to turn around and say, well, governments will step up fast enough that we won't see any companies go broke, or we won't see that huge corporate debt load actually become an issue. That's where I've got concerns, and I think we can't rule out issues in that area as yet.
Martin, if no vaccine is found for coronavirus, what would the situation be in 6 months' time?
Look, I guess to some extent that's the crystal ball question, isn't it? Obviously, the virus is actually not an unknown virus, but how quickly they can find a solution to it from a vaccine perspective and manufacture enough and distribute enough, and that clearly is going to take some time. So while that's taking place, we still, to some extent, markets can be vulnerable. But again, it's really more around that time frame by which we see the containment right around the world.
And Damien, finally with you, if a vaccine is found, a treatment for the coronavirus is a matter of weeks away, how quickly do you think the market will rebound?
Oh, look, I think a matter of weeks would be. I think to expect a matter of weeks is way too optimistic. I think we've got enough problems in the world with anti-vax people going on about vaccines that have been out there for dozens of years. I think they do need to send this through some quite rigorous studies before you can set it out widely. I think you've got a considerable period of time, and I'd actually like to harp back to quite a while ago to look at the effects. If you look at some of the effects of cities that have had big outbreaks, what tends to happen is cities that don't do anything, it is actually relatively short and sharp. You get a lot of people die, hospitals get overrun, and the effect is all over within a month or two. The cities that put down lockdowns and actually have much lower, it tends to last at least 3 or 4 months that you sort of get rolling effects of these virus coming through. So we think your best hope is that you do get a lot of these lockdowns that we've seen in the rest of China, and that you really get this long, slow recovery, as opposed to what you might, somewhere like Wuhan, where you might see that you've had a very short and sharp, and a lot of people die and very bad conditions, but the disease passes through as many people as it's going to pass through, and sort of you move on to the next phase. So I guess we're looking for something to be a bit more extended than what most are looking at.
Damien Klasson in Melbourne and Martin Lakos in the studio. Thank you.
My pleasure.
Thanks a lot.